My name is Laura Wilson, Firm Administrator at Wilson Law Group. This is the third chapter in the Trustee Orientation 102, the Administration Process Collection. The presenter of this collection is Attorney John Haslam. Attorney Haslam is an estate planning law specialist and accredited estate planner certified by the National Association of Estate Planners and Counsels and accredited by the American Bar Association. In this chapter, he will provide a summary of the current tax laws and how they might impact how assets are passed down. Remember to take note of any question you have along the way. Let's begin.
Last time, we talked about how to value an estate. Let's move on to the discussion of the estate tax. Now that's a tax on the transfer of wealth when you pass away. It's an excess asset tax. By that we mean if someone passes away and has too much money, there's a tax on the amount that the Internal Revenue Service deems to be too much. In Wisconsin, there is no state estate tax. But if you have assets in a different state, you should check their laws about their estate tax. Back at the federal level, there is also an estate tax exemption. That means if you pass away and your estate is worth less than the exemption, then your estate is not large enough to be subject to this tax. If you have to file an estate tax return, and one of the reasons you have to file is that your estate is larger than the exemption, that is done on Form 706. Again, that form filing is mandatory if the deceased person's interest and assets, which includes retirement accounts and life insurance proceeds, exceeds the exemption. The Form 706 estate tax return is due on or before the 9-month anniversary of the date of death. If any tax needs to be paid, that payment is also due within 9 months of the date of death. For estate tax purposes, the estate tax exemption is the maximum amount that a deceased person can transfer to a non-spouse beneficiary without incurring federal estate tax. Non-spouse is capitalized because you can transfer an unlimited amount of money to a surviving spouse. That's known as the unlimited marital deduction. So, you can transfer an unlimited amount to a surviving spouse, and you can transfer up to the estate tax exemption to a non-spouse. Someone can pass away and not transfer their exemption to a non-spouse. An example of that would be everything passes to the surviving spouse, or the deceased spouse doesn't have that much money in their estate. Whatever they don't use of their exemption can be transferred to a surviving spouse if they have one. But in order to do that, it is necessary to file that estate tax return. So, people with smaller estates will still file an estate tax return even though their estate is below the exemption. And that is necessary in order to transfer their unused non-spouse exemption to their surviving spouse. In that case, the surviving spouse then can use their own exemption plus what was transferred from their deceased spouse when they pass away. Back to our flow chart. You see when assets pass down to the middle level, you've got the survivor's portion going into a survivor's trust. The deceased spouse's portion can go into either the marital trust or the family trust, or a combination of those. Those are receptacles for the deceased spouse's assets. The marital trust is colored yellow, just like the survivor's trust. The transfer to the marital trust counts as part of the unlimited marital deduction, meaning it will be included in the surviving spouse's estate. The benefit of doing that is that any asset in a yellow box when the survivor passes away will drop to the lower level with a brand new basis. In the event transfers of any assets of the deceased spouse goes to the family trust, which is a green box, those will be excluded from the estate of the survivor, meaning they won't be added to the survivor's total when calculating the federal estate tax exposure. However, the family trust will not get a basis adjustment before dropping down to the bottom level. Those are all decisions that are made at the time the first spouse passes away to determine which assets of the deceased spouse will go into which box.
This ends the third chapter in Trustee Orientation 102, the administration process. If you have any questions about the information covered in this chapter, please contact the trust maker, your attorney, or call or email our office. Attorney Haslam will continue this discussion of the administration process in the 4th chapter entitled Division of Assets. Thank you for listening.